I'm Brian Rich with Money Markets TV. Despite all of the underlying problems in the world, for the past few weeks, the dominant focus on markets has been on the interest rate outlook. The big question, which major central bank will be the first to move rates off of historic lows and start a cycle of rate hikes? At first, the US was in the pole position. But after the economy began sputtering around the middle of last year, that notion was put to bed. In fact, the Federal Reserve rolled out more accommodation, another dose of quantitative easing. And based on the Fed's focus on general economic stability in its policymaking decisions, it seems clear that it will keep interest rates ultra low for quite a while longer. So now, investors' attention has been shifted to the Eurozone rates, and the European Central Bank. But how can Europe even consider raising rates when many of its members are on life support? It's a good question. Under the Eurozone's current accommodative monetary policy, Greece and Ireland both required rescuing, and Portugal and Spain are heading in that direction. But ECB President Jean-Claude Trichet and other policymakers have indicated that a rate hike could come as early as next month. They're risking exacerbating the debt problems because they're focused on just one thing: inflation. In the past, whenever the central bank's favored measure of inflation went above its target level, interest rate hikes have followed. And that's right where we are now. If the ECB does raise rates next month, it will have big ramifications for the euro. After all, interest rates play a huge role in currency valuation. In normal times, a currency with rising interest rates tends to attract capital, and strong capital flows tend to lead to a strong currency. But these aren't normal times. So will higher rates be a boon or a bust for the euro? The last time the ECB raised rates, back in 2008, it triggered an exodus into euro. In fact, right before the final rate hike nearly 3 years ago, the euro was sitting at an all-time high against the dollar. In the 4 months following, it tumbled to 23%. What happened back then could be very instructive, because Europe is facing a lot of problems, just as it was in 2008. The PIGS countries, Portugal, Ireland, Greece, and Spain, are in big trouble. The EU's attempt to return government bond markets back to normal simply hasn't worked. The cost of borrowing for weak Eurozone countries remains at unaffordable levels and has been rising steadily with the prospects of an ECB rate hike. And the hits keep coming. Last week, Greece and Spain were downgraded by Moody's, and Portugal is on downgrade watch. Given that backdrop, a decision by the ECB to move rates higher would likely mean bigger problems for the sovereign debt crisis. And that means big problems for the euro as well. In short, it's clear that European officials still don't have a solution. And that's why it's so important to keep a close eye on the euro here. I'm Brian Rich from Money Markets TV. Thanks for watching.